This episode is sponsored by Visible Alpha. While traditional consensus providers offer limited line items and forecast periods, Visible Alpha fills the gap by creating the deepest consensus data in the market with more and higher quality sources and longer term forecast horizons. Through relationships with over 165 brokers, Visible Alpha sets a new industry standard for consensus data across all of the companies and industries, products, segments, geographies, and more. Rather than digging through the financial models one by one, Visible Alpha extracts data from every line item across sell-side models so professional investors can save time and better understand analysts' expectations on metrics beyond just revenue and earnings. Join our rapidly growing buy-side client base and streamline your investment research workflow so you can focus on generating new investment ideas. Listeners are invited to try Visible Alpha for free by visiting visiblealpha.com/value. That's visiblealpha.com/value. Hello and welcome to the Yet Another Value podcast. I'm your host, Andrew Walker. If you like this podcast, it would mean a lot if you could follow, rate, subscribe, review it wherever you're watching or listening to it. With me today, I'm happy to have Mordecai YAVB. Mordecai is the founder and portfolio manager of Focus Capital Advisors. Mordecai, how's it going?
Good, thank God. Thank you for having me.
Thanks for coming on. I'm really excited to have you on. Having met you, I kind of wish I had you on in the July timeframe because I know what we would have been talking about then, but I think this is a good one too. But before we get there, let me start this podcast the way I do every podcast. First, a disclaimer to remind everyone that nothing on this podcast is investing advice. That's always true, but we'll be talking about a company that's foreign domiciled. They have an ADS, so they trade American, but they are a foreign company. Probably adds a little bit extra risk. You know, this is a merger arb situation, so adds a little risk there. Please consult a financial advisor, do your own advice. This isn't investing advice. Second, with the pitch for you, my guest, I mentioned July timeframe because you were one of the few people who were riding hard with me on the Twitter train. I know you swung quite hard at Twitter, but look, you run a concentrated, I'm going to call it event and quirky portfolio. I know you run concentrated. You do great.
Mostly not event. That would be a weird situation. It comes up, I had to hit it.
But look, you run very concentrated. You do deep work. We were having fun chatting before, so I'm really excited to dive into this one. The company we're going to talk about today is Silicon Motion. The ticker there is SIMO. You've got a deck on your website, which I'll link to in the show notes. Anybody can check it out. I believe the tagline for it is merger arbitrage for people who don't like merger arbitrage. So I'll just flip it over to you. What is Silicon Motion and why is it so interesting today?
Okay. So let's first talk about what's bad about merger arbitrage to explain why this is different. The usual problem with merger arb is that most merger arbitrage is either small spreads for companies that the market expects for the merger to close, and you're collecting your little spreads until one of the deals blows up in a totally unexpected way, and you lose a lot of money, kind of picking up nickels, dimes in front of the steamroller. That's not such an attractive approach, especially for a concentrated portfolio like mine is. Maybe it could work. Some people have done work with that. There are specialized merger arb shops that have sometimes had success with that, but that's not for my investment philosophy. The other type of merger arb is where you have a very large spread because a lot of people have looked and seen the risk of the merger not closing. There's a lot of questions usually about regulators, sometimes about finances, whether the shareholders will approve it, et cetera, et cetera. So it's not clear that the merger will close. So you have a large spread, but then you have a large risk as well. Large reward, large risk. That is, in theory, can be attractive, but I'm not so attracted by risk. I like large reward, low risk. So that's what I believe we have here with Silicon Motion. Silicon Motion is a Taiwanese company with, as you said, an ADR in the US. It's being bought out by Max Linear, an American company. And right now they're trading for about $66, $67, and they're being bought out for about $108. Almost all of it, the vast majority of that is cash, $93.54 cash, and 0.388 of Max Linear shares. That comes out to about $108 at the present prices. That is what we have here is a 60% spread on the merger, which is very large, even for large. You know, you have a company where FTC is suing that Microsoft should not be able to take over Activision, and the spread is only about 30%. And here you have a 60% spread. So I would say that the market is very negative on the merger closing.
If I could just dive in, when I was getting ready for this podcast, I was doing my standard. I'm sure you've got it. You've got your, hey, if you've got cash in stock, here's what everything's worth. And as you said, here's the spread. And I did it the first time, and I forgot to drag my cells down to include the value of the share component. So I only had the $90+ in stock, and I was like, oh, 40% spread. That's pretty big. And then I was like, oh my gosh, I forgot about this extra $20 in share. Like, it's big, even if you ignore the share. So, just neither here nor there. Just a funny story about me not being super confident in Excel.
Exactly. When you forget part of the price, you still have a 40% spread. Exactly. The spread here is out of the world. And the reason is pretty obvious, I think, for most market observers. Silicon Motion is a semiconductor company. We'll get to discuss exactly what they do. But they're a semiconductor company, a Taiwanese semiconductor company that's being bought by an American company. And among all the approvals it needs in the world, which it already has, the one that it has not yet received is Chinese approval. Given all the, we'll call it tension between America and China now about semiconductors, with America banning China from buying many advanced semiconductor technology, etc. I'm sure China is not happy with America's semiconductor policy at the time. So the question is whether they will allow an American company to purchase a Taiwanese company in the semiconductor space when they have the right to deny approval. That seems to be, the reason why most people are expecting not to close. It's officially is supposed to be reviewed by Chinese SAMR, SAMR, which is an antitrust review. On an antitrust basis, there's really nothing to pick on in the case because MaxLinear and Silicon Motion don't have any overlap. They're both semiconductor companies, but in different niches. So there's really no overlap, no antitrust risk at all. So if they were following the rules, there's really no way for them to deny approval. I don't think there's a reason to believe that China has to follow their own rules. So will China approve or not approve? I have no special insight. Very well, they might not. Probably the simplest thing for them to do is just drag their feet and not respond until they run the clock out, which I think is the preferred method of when they want to deny approval. Just I'll get back to you.
And for anybody who's done event, we're very familiar with this. Just this year there was Rogers Dow, or was it Rogers DuPont? One of the two. I'll probably bring that up later. The famous one everyone remembers is NXPI, Qualcomm, back in 2016 or 2017. So people are very familiar with China using SAMR to just drag out until eventually the company say, all right, there's no way this merger is going to go through.
Exactly. So this is the situation where I said a high risk of it not going through and a high spread, and I just described that type of situation as being unattractive. So why do I say Silicon Motion is a merger arb for people who don't like merger arb? And the reason is because I happen to believe that Silicon Motion is worth much more alive than dead. I believe that if the merger doesn't go through, we will make more money long term as shareholders in a standalone Silicon Motion than we would by it being purchased. Fun fact, when Silicon Motion announced their merger to be bought out for about $107 a share by MaxLinear, I actually reached out for legal advice to see if there was any way I could block the deal because I believe that $107 vastly undervalued Silicon Motion as a company. It turns out that Cayman Islands domicile, there was no real way to there was nothing to sink the teeth into. So we didn't have a way to try to block it. But if this deal doesn't go through, I think that's great for investors. So basically, the way I view it is 60% if the deal goes through from the present price, and even better if the deal doesn't go through. So really, although I call it a merger arb, it's really a fundamental deep value play on Silicon Motion as a standalone company, even if we have no opinion about the merger. So let me discuss what's so attractive about Silicon Motion as a company. So I'm basically going to say Silicon Motion has, I would say trifecta, but I want to say four things. Quadfecta, the quadfecta of everything we could want in a company. 1, highly profitable. 2, fast growing. 3, low risk and diminishing competition. And 4, super low valuation. You do not usually have all 4 of those at the same time. It's usually, profit, growth, or cheap. Pick 2 or 3, or pick 1 of 3 sometimes. And this has all of them: highly profitable, fast growing, low risk, and cheap valuation. So really, I think this is the if I can get 5 companies like this for my fund, I would go for it. As you mentioned that I run a concentrated fund, so I only invest in very high conviction ideas. We invest in 4 to 5 companies at a time. So it's got to be high conviction to slot into my fund to begin with. And this is the highest conviction idea I've ever had. We're holding about 35% of the funds in Silicon Motion, and the last long letter that we wrote about Silicon Motion's all the moving parts, we actually titled it "Pounding the Table on Silicon Motion." That the price was around here about 60. It was a few months ago, near the end of 2021, before the merger was announced. It was trading around 60, and we said that this is just not a price. This price that does not make sense for the future of this company.
I want to dive into a bunch of things you said, but let's just start with one. It's common in event land where you'll see something that's got a rocky arbitrage or even just a normal arbitrage, and people will say, look, this thing is trading discounted because no one wants to touch it. There's no natural buyer, right? The classic, I all the time, like a utility company agrees to sell for 10, 2 months, a year later, the utility index has doubled and the stock's trading at 980 because there's questions over if the deal goes through or not. And people will say, look, this is because no utility funds or anyone who indexes to the utilities can buy this because it's under arbitrage, and no arbitrage people want to underwrite the fundamentals because they want to get 10 or get out. And so it's kind of broken that way. Do you think something similar is happening with Simo, where it's, hey, if you're a fundamentals guy, it's pretty obvious that the merger arbitrage here is really rocky and you don't want to step in front of a deal break. And then if you're a finance guy, if you're a merger arb guy, it's pretty obvious the deal's rocky, so you don't want to kind of underwrite too much in fundamental value. Do you think that's what's going on?
It might be. Listen, people ask me, I've been asked, if the deal breaks, what will the stock drop to? So I'm torn between thinking that the stock has already dropped, that this is the price that the market thinks it deserves if the deal breaks. The market isn't pricing in the deal. That's one way of looking at it. The question is really the shareholder base now. Is it mostly people who are believers in Silicon Motion and are waiting either for their $107 or for the company to continue as a standalone? And I know there are many shareholders like that in the base. Or has it mostly transferred to merger arb hands who are hoping to get the deal on the maybe they don't think it's likely, but it's enough of a spread to attract them anyways. They figure that even if it breaks, it won't go down so much. But then there'll be a lot of forced selling. If the deal breaks, all the merger arb people are going to leave, and then they'll just be dumping it even if it doesn't make sense. I don't know. I can't tell you right now what percent of the float is in merger arb hands, which will dump it on a break, and what percent of the funds are in index funds or in other long-term shareholders that are just going to keep going at it anyways. So I don't know. I don't know if the merger breaks and the stock drops more, it'll just get more attractive. So it'll be reason to buy more. I always feel that trying to time the same way we can't time the markets as a whole. You can't time a company. You can't say this is a great company. It's worth double, triple the price. But buy in 4.5 months and 3 hours. I mean, I can't tell you when to buy. I know that now the price is extremely attractive, so I say go for it now. That's the way I look at it.
I think we mentioned Twitter when I can't remember if I said explicitly or implicitly, but when I said we had something to talk about in July, I was referring to Twitter. And one of the things, I mean, I don't think I swung as big as you, but I swung pretty big. But one of the things I regret is if I started from the end and worked backwards, I was like, Twitter is 95% to win this case. And I always thought that every time, but I never quite, I certainly never swung like I thought it was 95%, because I would joke to people, Kelly Criterion said, if you think this is 95%, you should sell your kidney, sell your house, sell your dog, and put it all into Twitter. And I certainly didn't swing that. But I never swung quite as hard as I wanted to, because I was like, I'll wait for the trial to get a little bit bigger. I'll wait for this event. And then, it settled all of a sudden out of nowhere. Elon just said, I throw in the towel, I settle. And I kind of regret,
if you're that convicted, just start from the end, work backwards and say, take the position now. And that's obviously what you're doing. You're kind of like cutting up theirs. But there's two things we need to talk about here, right? We need to talk about the merger arbitrage angle, which if it plays out, you might not be happy, but I think a lot of people would be happy walking away with 100 in the near term. I think it's unlikely. People can see that from the share price, but we should discuss it. And we should talk about the fundamental angle. So where do you think we should start?
I think we should start from the fundamental angle. I think
okay.
The base value of any company is to understand what the company does and why it's worth more, if it is.
Great. So let's start with the fundamental angle. You mentioned a couple of things in there. You mentioned growth. I think the thing you've mentioned, and I've heard about you talk about it before, you kind of started alluding to it, is that they are, I don't want to put words in your mouth, but they're a little moaty and they're getting more moaty, right? They're taking a little bit more share. They've got great partnerships. A lot of the competitors are exiting. So if you can expand on that and we can use that as a jumping off point for fundamentals.
Let's first tell everybody what Silicon Motion does. They're probably waiting. I don't know how many minutes it was, but 15 minutes in, we haven't said what they do. They're a semiconductor company. What do they do? So Silicon Motion makes controllers for NAND flash. NAND flash is the memory that's ubiquitous in modern computing, iPhones, iPads, smartphones, tablets, your laptop, your computer, the data center, anywhere that has storage. It used to be hard drives, has all been transferring to flash memory, SSDs, etc. The data center, your automotive, in the infotainment center, in the telematics center, in the self-driving, Internet of Things. If your toaster oven has some sort of SSD, I don't know what they're putting it in nowadays, but that's a fad, the toaster oven part. But there is a growing Internet of Things. The home video cameras, the industrial, lots of places with flash memories going. Everywhere there's flash memory, there's a flash memory controller that runs the flash memory, and it's important for wear leveling. It's important for garbage collection, for prolonging the life of the memory, hardware level encryption, all the different things that depending on what the end case use is, what the end market is, what type of controller you need, but they all need controllers. Everywhere there's flash, there's a controller. Silicon Motion is the largest merchant controller, provider of flash controllers. What do I mean by merchant provider? So flash is made. There are 7 companies that make all the flash in the world. Yeah, so that's Samsung and SK Hynix, are South Korean companies. Then we have Kochia, formerly known as Toshiba, that's a Japanese company. Then we have Micron, Western Digital, and Intel, which was bought by SK Hynix. And those are American. And then we have YMTC, which is a new entry from China, but has started to catch up, and now I think they're already at the commercial level of actually having customers. So those are the 7 flash makers in the world. The 7 flash makers, they can make their own controllers. That's an in-house controller. And then a merchant controller is when there's a different company making the controller and it's being paired with the flash from these 7 flash makers, either by the flash maker themselves or by a third party called module makers. Module makers buy flash from the flash controller, from the flash makers, combine it with a controller from Silicon Motion or someone else, and then put together the package and sell it outward to the market. So Silicon Motion's customers are the flash makers themselves, these module makers, and also in a large sense, the customers are their customers, the OEM, the Dell, the HP, the Apple. I don't think Apple's a customer, but the OEMs who are making the products, they're highly involved in choosing who they want to be their provider for flash, who they want to be their provider for the controller, etc. So those are the pretty overall overview of what the market looks like.
Perfect.
Historically, the risk, I'm just going to start off with what we were talking about, how the risk is diminishing and competition is exiting. The biggest risk that has always faced Silicon Motion, at least the market fear, has always been that the in-house controller teams by the flash makers, that the flash makers will take more of the market for themselves, squeeze out Silicon Motion and other merchant controllers. What's actually been happening has been the opposite. Over the years, more and more, the flash makers have been outsourcing their controller needs to third parties like Silicon Motion being the largest. And the reason for this is actually pretty simple. The flash makers, their competitive advantage is knowing how to make flash, building the fabs, bringing down the cost of the fabs and the cost of the production, the manufacturing on the flash. That's their competitive advantage. That's their secret sauce, and that's where they have to go and compete in the market. Actually, making the relatively small percent of the chip of the controller can be as little as 50 cents. It's not it's a critical component. It's needed, but it is not the majority of the package, any shape, size, or form. And they can't amortize the cost of every new generation controller being more sophisticated and more expensive. They can't sell to their competitors. Samsung's not going to be able to make a controller and sell to SK Hynix. SK Hynix is not doing business with Samsung. They're competitors in flash. They can't buy controllers from each other. So they're limited by amortizing the cost of development of controller over their own production only. Silicon Motion can amortize the cost of controller across the entire ecosystem.
So Mordecai, if I wanted to just like dumb it down, and obviously it's not quite this simple, but if I went back to the 90s and 2000s, could Dell and HP, could each of them have made their own operating system and made their own processing chip? I mean, technically, yes. There's lots of network effects and everything that I don't think would apply here that would have applied to Microsoft and Intel, obviously. But, especially on the processor chip, technically, yes, they could have. But you know what? It was probably better for Intel to do all that R&D, build the giant fab, and then sell to Dell, Microsoft, Dell, HP, Apple, all of them, and amortize that cost over a much bigger base. So here, I mean, I'm not saying it's as Modi as Intel in the 90s, but it's a buy versus build, and all of them are saying, hey, we're 1 of 6, 1 of 7. We have 20% market share. If we give 100% to someone outsources is making this thing that, is a reasonably small cost of the overall all-in package, it actually makes more sense. They'll be able to amortize the R&D, amortize their scale. They'll be able to produce it basically, bottom line, cheaper than we could if everybody did this in-house. Am I thinking about that correctly?
Absolutely. The flash makers have to retain some controller talent in-house, because as they're developing the next generation of flash, they have to be able to test it. They have to be able to see how well it's working. So they need some sort of in-house controller talent. And at the very high end, where controllers are extremely expensive, I discussed controllers are 50 cents a chip. You could get controllers for a few $1,000s a chip at the very high end. So at the very high, pretty high end enterprise. So that's already more attractive, higher margin, relatively, for the flash makers to compete in. That market they're still competing in as a core competency. But the lower end and the mainstream, that's a leaving over for Silicon Motion. So let's talk about all the various competitors over the years who have just fallen by the wayside. One of the big competitors was Marvell. Marvell was, let me first take a step back and break down the different divisions of the company. Silicon Motion has basically two main divisions cover most of the company, and then there are three main divisions cover the company. The first main division is the client SSD. That's the hard drive replacement. It goes into computers, laptops, low-end data centers. There's also enterprise SSD, which they are entering but have not really entered yet until probably late next year. But client SSD would be in, as I said, computers, laptops, game consoles, and low-end data centers. Then that's about 50% of their revenue. Then there's eMMC and UFS. eMMC and UFS, eMMC is a legacy smartphone technology. It's still used a lot in low-end smartphones and Internet of Things. But the successor technology is UFS. That's being used on the premium end of the smartphone and the mainstream as well nowadays. Probably will eventually go down to the low end at one point. that EMC and UFS business is about 40% of the business. And then the rest of the business is industrial, and they have a division, Shannon, which does Chinese hyperscale data centers. Basically, basically means they sell to Alibaba. Basically, they're one customer, Alibaba and Baidu. Also a little bit. That hasn't been doing so well, that part of the business. It's a small little sliver. I guess it's optionality that maybe that'll take off one day. But basically right now we're looking at the client SSD and the eMMC UFS. That's 90% of the business. So on the client SSD side, Marvell, who used to be very big in hard drive controllers, so as SSDs were taking over the market, they started doing SSD controllers as well. Marvell, of course, is a heavyweight, much bigger than Silicon Motion. Marvell was not successful in competing with Silicon Motion. Marvell's, you saw on their revenues and profits in that division were, kept on decreasing. They were actually asked on the conference calls, you could read or listen, the conference calls where they were asked point blank whether competitors say that they're winning share from them, and they were reference to Silicon Motion. Nobody mentioning anybody's names, but Silicon Motion is winning share from you. And then no, we're not really true. We're doing fine. We're doing great. They kept on saying they're doing great until they announced in 2018 that they're pivoting away from the client SSD space to focus on enterprise SSD, and where they are, which is a major chunk of the business now, enterprise SSD, but client SSD they basically abandoned because they were being unsuccessful. You could see for yourself as the SSDs come out, you see whose controllers are in them, and Marvell was having less and less of the market, and Silicon Motion and a little bit Phison were getting more and more of the market, and Marvell just being squeezed out. So that was the first, competitor that just exited stage left, 2018. 2019, Kingston is technically a module maker. That is, that they don't make any flash. They're buying the flash from the flash makers and pairing it together with controllers from third-party companies and selling on. But Kingston is almost a tier one company in terms of they're almost as big as the module makers. They themselves are selling 10% or more of the world supply of SSD. So Kingston is very big, yet client and an enterprise. Kingston was actually a shareholder, 7% shareholder in a competitor of Silicon Motion, Phison. Joint venture with Phison, and they exclusively used Phison's controllers. That was till 2019. 2019, they started using Silicon Motion, and they've been increasing 2020, 2021, 2022. They kept on increasing Silicon Motion share by Kingston. And that says quite an endorsement when you're basically the joint venture competitor is coming to you for the controllers and moving away from Phison. It just shows you that Silicon Motion was succeeding in execution and the R&D and putting out the product at the price point that customers wanted, and the winning market share. Then in 2020, they had one client SSD a customer that was direct flash, one of the flash maker customers. They had one in 2020. 2021 they have two. In 2022 they have seven, which is all of them.
Yep.
Started working with basically everybody, not just module makers. And their OEM business, which is very important, there's two parts of the business. The module maker business is a little opportunistic. Depending on the price of flash, they get allocation. They need to get allocation when there's tight supply of flash in the market. The module makers are last on the list to get. When prices are high, they're last on the list to want to buy because their margins are being crushed. So they're more opportunistic buyers. They want to buy more when the prices are down. When the supply is high, then the module makers are coming in and buying flash and therefore need controls. When the prices are high, supply is tight, module makers are not there as much. So module makers in the business, they want it. They historically had about 70% of the module makers' client SSD business. But the OEM market, meaning the Dells, the HPs, the Apples, who are long-term contracts, They need to multi-year roadmaps. They want to lock in their suppliers, know who they're using, and they want to make sure that they have that supply. And even when prices go up, they still need the supply. They still need to be selling, buying flash, producing product, and pushing it into the market. So they historically had maybe like 25% share of the OEM market. 2020, that went up to like 30. 2021, they had 40%. And in this year, 2022, they won 50% of the OEM slots. So as you see, a line up and to the right of growing that market share.
Who's got the other 50% at this point?
So some of that is going to be the flash makers themselves.
Yep. Okay. Just making sure. Yep. That's who I thought.
Phison is probably the biggest competitor. Phison is the biggest competitor. Phison is somewhat a merchant controller where they sell to third parties. It's a little bit also a captive producer for Kingston a little bit, and for Toshiba, who is also an investor in Phison. So so you could call them a merchant controller. You could look at them a little bit as a joint venture arm of Toshiba and Kingston.
You've talked about how a lot of the potential competitors have come in and given up or lost a lot of share. If I just said, Mordecai, of the controllers, of the flash controllers out there, what percent of the outsourced market do you think Silicon Motion owns, and what percent of the overall controller market do you think Silicon Motion owns? What would you say?
It's hard to give an exact number on that. The module makers, SSDs, they have about 70% share.
70? 70?
Yeah. On the module makers as client SSD. On the OEM SSD, they're having around 50. So,
and that's overall. That's not outsourced. That's overall. So including the stuff that the flash makers are making into. So they, and all of their divisions, they've got the majority. I mean, if you've got 70%, obviously your multiple is bigger than any possible competitor.
OEM. So I would say that they have yes, quite a decent share of on the eMMC. It's a little harder. Phison, I think, is much larger in the eMMC market than the client SSD market. I believe still that overall the Silicon Motion has about, it's hard to say what the share numbers are.
It's fine. It's fine.
40 and 60.
So let me just jump to a question that I think, look, I'm a generalist. I think a lot of people who listen to this podcast are generalists. Not a lot of people are semiconductor experts, right? But I do think a lot of journalists will hear this and say, oh, this is a great story, right? You've got a niche product. You've got a company that has the majority of market share. We've already described how it's a growing market. We've already described how, I mean, anybody who hears, hey,
I think I misspoke before when I was referring to the outsource market when I said those numbers.
Okay.
The numbers of the outsource market. Samsung does all their client SSDs. Almost all the client SSDs are in-house by Samsung, and that's about 30-40% of the market. That's kind of close. If Samsung ever decides to outsource their client SSDs, that would open another avenue of growth.
Tell me if
the market is probably closer to 40% of the 30-40% of the entire market.
Even though that's huge, but tell me they do have partnerships with Samsung, right? Like Samsung has started working with them. And I know in 2023, I think they've got partnerships announced that will ramp up their Samsung work.
Yes, Samsung, okay. and also on eMMC, they're partners.
And we'll come back to, but I guess, if you're a journalist and you're hearing a lot of good stories here, but I think any journalist is going to hear, oh, they serve the flash drive market. And every journalist has seen Micron at one point, and the stock is just, for people who aren't on the YouTube, the stock is a wave, right? You're hitting a cycle and there's a bad flash cycle and prices go to hell and, it's oversupplied and Micron stock is down 80% in a year. And then 2 years later, tight supply, prices are going through the roof. Micron stock's a 5X inside a year. Everybody's seen the Micron stock. And I think people are going to bullwhip effect, all this sort of stuff. People are going to say, oh, these guys are supplier flash. We've seen what happens to Micron stock. Why are these guys not going to be super cyclical? And yes, we're going to talk about the low PE in a second. We're going to talk about the growth story, but everybody knows semis are getting crushed right now. why, when people look at these and they're thinking the fundamental story, are we not saying, oh, next year is gonna be bad as oversupply, flash pulls back, all that. And I would add, I guess I'll add stuff from the proxy stat in a second, but I'll pause there on that question.
That's a great question. And it's a great question to bring out why this has absolutely no similarity to Micron at all. Micron, when flash prices go down, hurts Micron. Micron sells flash, and they end up selling at negative margins and losing money. When flash prices go down, that does not hurt a Silicon Motion's business at all. It actually helps Silicon Motion's business. As flash prices go down, it's more attractive than the remaining hard drives, the remaining part of computers that are still using hard drives. Flash drives become more attractive. They get used more. They are tied not to the price of flash, but to the volume of flash. If the price of flash goes down and the volume goes up, that helps Silicon Motion's story. Silicon Motion is selling the controllers. The controllers are a different business. The more flash is sold, the more controllers are sold. If flash is used less, that would hurt Silicon Motion. But in terms of the overall usage of flash in the market, both on a percentage of what's using hard drives, what's using flash, I mean, by now, it's already almost not 100%, but it's getting pretty close to maybe 20% of the computers still using hard drives. I don't know exactly what percentages are on data centers. It might be even less. Probably depends on the type of data center, actually. The ones that need high performance, like Google and the Alibabas of the world, are basically all using SSDs by now. So but the volume of all this is just growing everywhere. Flash memory, besides the percentage, the market share that flash memory has of the memory of the storage space, the storage space is just exploding. Data centers need more and more memory. I said automotive, Internet of Things, everywhere flash memory is being inserted. Flash memory could crater, that helps their business. Now, I want to do one caveat on that. If you go back to the 2018-2019 cycle where flash memory cratered, that actually hurt their business. Now, I just said when flash memory goes down, that helps their business. So
you're cutting off my next question. Go ahead.
The answer is that in 2018 2019, most of their business was still module makers. Module makers, although they benefit from a lower cost, like I said before, they don't benefit from a volatile market. Then, not only was flash low, it was cratering. And the module makers were nervous of being stuck with inventory that was at the wrong price. So they didn't want to make large purchases. And then the price would go down and they would be stuck with inventory that they couldn't sell. So the module makers pulled back because of a volatile market. And since a lot of the business module makers, that hurt their top line. And secondly, they had their other division, which the 10% part, at the time it was structured that they were buying flash, packaging it, and selling it to Alibaba. So that was fine and all, but then they got stuck with inventory risk, and they had to take somewhat of a write down on that. Now, all that said and done, they were highly profitable during the bad years of 2018, 2019. Their gross margins were close to 50%, just like they always are. Their scale went down a little bit, so their operating margin got hurt, but their operating margin, they were profitable throughout, always building up cash. No debt on the balance sheet, by the way. Constantly profitable, even at the time that they were struggling because the module makers were pulling back and they themselves had to suffer right down. And they were still profitable, everything said and done. But with the OEM market is multi-year, sticky contracts. And by now, about 50-60% of the business is already OEM market. A lower, even a volatile price won't really affect the OEM market. They're buying at high prices, low prices. They're going straight. A recession, which hurts the end market, obviously, will filter down to Silicon Motion as well. They have no more visibility into the world economy than anybody else. But they're gaining. They're kind of a double growth story. They're gaining share in a growing market. So it's a secular growing market. Flash, memory is a growing market. Flash is gaining share in the memory market, and they're gaining share in the flash, which is gaining share. So it's like, I don't know, call it triple growth if you want. Gaining share in a growing market,
So let me just, I hear you. So I think what you're saying, this is a long-term growth story. It's priced attractively. Whether, as you said, when the merger got announced, you thought it was worth more than the merger price. And it sounds like you still do. But I hate to dig into the next year is going to suck angle, but I do just want to dig into that a little bit more. I look at, so as part of the merger, and we'll come back to the merger arbitrage in a second, they publish a proxy, right? And I believe the proxy projections were made in late Q1 2022, right? So they published proxy. 2022, they say we're projecting 1.15 billion in revenue with EBITDA of 366 million. For the first, they're not going to do $1 billion of revenue this year, right? And EBITDA, I don't have the EBITDA number, but they're going to come far, far short of that EBITDA number. And you see gross margins in Q3 22 I think gross margins are coming down below to 47% for the first time, well below 50% for the first time in a while. Operating margins have come down to 25%, which is kind of where they were at the nadir in 2019, if I remember correctly. They were even lower in 2019.
Yes, they actually in 2000 they entered 2021 with 20% operating margins. 2021 brought them up to 27%. That dropped a bit down now to 25%. I think over the next few years they'll reach 30.
Okay, yeah, because I'm looking at 2000. I was looking at 2019 overall. I was looking at Q4 accidentally, but that was 24%. For 2019, they did 21%. But still, they're starting to get pretty low. So I guess just I'm rambling here, but it's easy to say, hey, look, long term, this is growing, all this sort of stuff. But I think people are saying, ooh, the cycle seems like it's turning, and it seems like it's turning pretty quickly when you're talking about in 5 months going from 1.15 billion projection to under $1 billion. Like, it seems like it's turning quickly. It seems like it could get ugly.
Projection 1.2, wasn't it?
It was 1.15 for 2022.
Down to a little bit under one. That's not such a huge difference. You said 1.5.
Sorry, 1.15 to under $1 billion is what they're going to do in 2022.
About 10% difference.
It's projected March that you're going to do 1.15. So you've already got 3 months in, and you've got some projections to come under.
As I said before, they have no more visibility into the world economy than anybody else. They can project the next quarter, maybe, but not more than that. The rest is just what their customers are telling them, and the customers don't really know either. So, right, what the world economy will do, the semiconductor space, goes up and down, that's fine. But, if you look at the big picture here, in 2018 and 2019, 2020, they were doing about $500 million revenue. 2021, 2022, they saw the step change. The step change is because of all the competitors exiting the market. We spoke about client SSD, maybe we'll speak about AMC also. They had competitors exiting the market. They got much more of the market share in 2021, 2022, and they basically step changed from $500 million in revenue to $1 billion in revenue. And I want to emphasize that step change was a permanent step change. It wasn't, pandemic drawing in revenue. That wasn't. What I think
a lot of people probably do look at the growth in 22 and 21, or in 20 and 21, and say, "Oh, COVID beneficiary." And what you're saying
it was market share gains. It was market share gains. The market as a whole didn't grow that much. Certainly not in 2022, it's market share gains. They grew a lot of that market share. They grew from 500 million revenue to $1 billion revenue. They took their operating margins from 20% to 25, 26 is where they're holding now. And for 2023, this year already has been a year of a lot of suffering. 2020 they grew 20%, 2021 they grew 71% on the top line. 2022 has been a hard year for the semiconductor industry. They're only going to grow about 8%. That's on the bad years. Yeah. So they're a proxy that they put out in March. So don't use that proxy. Look at it for yourself. Yeah. Instead of growing, 71% that they did in 2021, which was a one-time step change, they grew 8% this year. But they have future growth built in. They're exiting the year with more OEM slots than they entered. So 2023 will probably have a higher market share overall than 2022. And they're starting to enter the enterprise market as well. They're sampling now, and they're entering probably full-scale production toward the end of next year. And that's a greenfield market for them. They haven't competed in the enterprise market as well, but they outcompeted in the client, and I can very well see them doing well in the enterprise market as well, which would be just adding growth on top of everything else. But even if they just stay at the 1 billion and then continue to grow as the market grows, we would still expect 5-10% growth, for a while, just in the markets that they're right now investing in, besides the enterprise market.
So I know you said don't look at the proxy. I can't help but look at the proxy, but I do just want to ask, you said when this deal was announced, I think the all-in at the time with the MXL price and everything, I think the price was around 110, 115 was the all-in value. Like, how do you kind of look at
They announced it as, but as soon as they announced it, Max Linear dropped because they're taking on a lot of debt for it. So really, it was about 107 from the beginning.
How do you look at the value? Because you did not want that price. Obviously, you think it's worth more. Because when my dumb model of it, again, I looked at the proxy, even if you told me not to, I was kind of looking like 2025 unlevered free cash flow in the proxy is 363 million. Slap a 10x multiple on that. Maybe that's too low. I'm not sure. That gets you to 3.6. And then I assume they get the break fee, the cash on the balance sheet. That gets you to about a $4 billion enterprise value. That would be about $120 per share price. And then I guess I'll just call the cash they generate till then versus the time value money fair value. So that would get me to about 120. Do you kind of, where would you disagree with those numbers?
First of all, the numbers on 2025 from the proxy are definitely made up. That's for sure.
I hear you. I know you told me not to, but a management puts that projection out there, and I can't help but just kind of sneak peek at it.
They have no idea the downside or the upside. That just pulled out of somebody's stomach. But so like this, the way I look at it is we're dealing with $1 billion revenue, about 25% operating margin. They're running about $200 million income, net income, which all flows down to the cash. $200 million of cash a year. And they're a company that I don't know whether they grew 8% in 2022 approximately. I don't know how much they'll grow in 2023. Maybe it'll be down. It's already been a year of tough semiconductor market. A lot of people are thinking that's going to start turning back in 2023, first half, second half. A lot of it has been inventory reduction. So it could start turning around. Maybe we'll hit a recession. I don't know. By the end of 2023, I think we'll probably most likely be ready turning back up. But whether yes or no, I don't expect 2023. We're not looking at a 20% cut by any way, shape, or imagine. At the most I can imagine maybe a 10% cut. I can easily hear a 10% or even 20% increase as well. On the long term, I see it growing at 10% a year, even if the enterprise is not successful. If the enterprise is successful, I can see the enterprise being another 50% on top of the business that we have now. eMMC and client SSD are both growing very rapidly. The end markets. It's a recession, so that might pause them for a little bit. But in the end of the day, it's a secular growth market, and they're not going away anywhere. Flash is still going to be used. So I see it as a $200 million net income. I believe the operating margins are going to go up over time to 30% as they get more leverage on the operating expenses as the revenue increases. So long term, I see them they're going to be making 2 years down the line. I see them making probably closer to about 300 million, 350 million. Let's say at the end of 2024. That's the way I see it. And I think that a highly profitable, fast-growing company should be viewed with a P of 15. I mean, I think that's low, but let's give it a P of 15. Maybe the Taiwanese discount, but TSMC is also a Taiwanese company, and they don't have a P of 9. Right now, Silicon Motion is trading at a P of about 11.5, and a quarter of the price is in cash. Is basically cash, current assets, highly liquid assets. So if you X that out, we're looking at a P of about 8.5. Yeah, I think they easily deserve double that just to be maybe fairly valued. Yeah, that's a price of about 130. And honestly, even at that point, you'd be getting a good company. It would be a fair price for a great company. A company that's continuing to grow, continuing to be profitable. As I said before, even in downturns, they've been very profitable, and their margins have been pretty steady. Their gross margins, they've gone down in the past. Sometimes they've had years where they were down back when they had the module maker and other issues. They were down 25% revenue, and their gross margins were almost rock stable. Yep. So gross margins go between 47 and 49 is basically where the margins grow, depending on exactly which section of the business is selling what. Is basically what it boils down to.
I just want to point out, you made fun of me for using the proxy number, and then your end game, the earnings number you threw out was 350 million-ish, which is what I got from the proxy as well.
That proxy was for 2025, I believe.
That is true. That is true.
I had that a little earlier.
Look, this is great. I'm a little worried about time, and people always laugh when I say, "Oh, hour-long podcast." I'm like, we could go 2 hours on a lot of these names, but I want to turn over to the merger arb by starting with what I think is like kind of important thing, both for the fundamental and the merger arb case. And that is, why did MXL decide to buy Silicon Motion, right? Because I think when you see that, it helps you think through both the merger arbitrage case and it helps you think through the fundamental case. So I'll kind of flip it over to you on that.
Well, honestly, I think the reason is because MXL CEO was bored and wanted to increase his fiefdom. They're a serial acquirer. They've acquired other companies. They take on a lot of debt for it. I don't know whether it will turn out well for Max Linear shareholders, honestly. Max Linear shareholders didn't get to vote on it. If they voted on it, they probably would have declined because of the extra debt. They didn't get to vote on it because they weren't giving away enough shares. It was mostly a cash transaction, which is probably why they structured it that way. They're going to take on a lot of debt. The debt's going to be more expensive with the higher interest rates now. I wouldn't be a holder of Max Linear personally. They're loading it to they're loaded to the help with debt, and they're adding more. But they're just trying to become a bigger semiconductor business. The way they say it is they want to have a larger economies of scale with TSMC and with their other semiconductor suppliers and manufacturers to be able to get better prices and better allocations, etc. And maybe there's a grain of truth to that, but give me you in the lamppost. At the end of the day, I think the CEO wants to be CEO of a larger company.
Yeah, so look, I think you're probably right. MXL stock drops 20% the day that they announced this deal. It is a big premium deal when they announce it. A lot of debt gets taken on, not a lot of shares, big debt. But so I think you're right there. That does speak to some concerns, though, right? Like they say, hey, we're buying this company with a lot of debt for, let's call it 110 per share or whatever the number was. Like if the market thought this stock was worth 150 per share, even if they were questionable, they'd be like, oh, you buying that with all debt? There are synergies here. The market, goes to the roof.
I don't know how much the synergies are real. Honestly, I don't think that. I think synergies are usually overblown. There probably aren't that many synergies, being that they're not in the same niches of the market. They can't. What's the main expense of Silicon Motion? The main expense of Silicon Motion is the 1,200 engineers that they have. 1,400 employees, 1,200 of them are engineers. They have to keep all those engineers. All those engineers are doing engineering work. They're not going anywhere. And then the next expense is the tape outs and the paying TSMC. There's not going to be too many synergies on that. TSMC is not going to go to Max Linear and say, "Oh, so now you're bringing me Max Linear and Silicon Motion business. We're going to give you 20% discount." I doubt it. I doubt that they're going to get much of a. There's still going to be tiny TSMC, and there's still going to be price takers on whatever TSMC charges their customers. I don't think the synergies are that real. I think that is concerning, but as you say. Even before the merger was announced, the price was trading in the market for $70, and I think it was worth more. So yeah, I think the market had a different view of the fundamentals. I think the market mostly is comparing it too much to Micron, like I said before, not recognizing that they're not cyclical like the flash makers themselves are. Two, are not attuned to how much of the competition has exited the market. We spoke on the client SSD side with. Marvell exiting, Kingston starting to use them instead of their joint venture, and the OEMs gaining more and more share, going from 25, 30, 40, 50% of OEM shares, and more of the flash makers outsourcing their client SSDs to Silicon Motion. If you talk about the eMMC side of the equation, the eMMC is supposedly a legacy technology. Low-end smartphones, the higher-end smartphones are now using UFS. But on the eMMC, might be legacy, but it's growing very quickly. The low-end smartphone market is still growing, and Internet of Things it's being used in, and it's growing very much there as well. In the eMMC market in 2021, Samsung decided there was a Texas, their fab in Austin, there was a freeze there, and the fab closed down. It took a while to restart. Samsung decided that the eMMC market is no longer core for them. They don't need to make those controllers. They're still making the flash, but the controllers they're not going to make. They're going to outsource the controllers to Silicon Motion, among others. Silicon Motion is basically the largest eMMC merchant controller out there. They're doing a lot of volume on the eMMC market. You could let's look at the difference. In the first half of 2021, before Samsung exited the market, they were growing the eMMC division by about 50%. Third quarter of 2021, they quadrupled. The growth went to quadruple. Just that's the difference between having a competitor and not having a competitor.
Yep.
So eMMC is highly growing, and then the UFS, which is the sequel, the high end and the mainstream of smartphones and tablets. They went from originally they were the exclusive supplier to SK Hynix's eMMC. One of the things that went wrong for them in 2018, 2019, we spoke a little bit about what went wrong. Everything went wrong at the same time. SK Hynix, in their transition from eMMC to UFS, decided not to use Silicon Motion, but to do it in-house. Yeah. So they lost, over a few years, they lost a large chunk of that business as SK Hynix's eMMC business turned to SK Hynix's UFS business, which wasn't using them. So they lost a good 23% of their revenue or so. So that was a large chunk. They made it up with eMMC to other customers. They made it up with UFS to other customers. They were the exclusive supplier to Micron's UFS. And they went from one UFS customer to two UFS customers in 2021 to 7 UFS customers in 2022.
Can you just real quick, the customer who decided to in-house, look, you're more familiar with them. When I do these podcasts, I generally look at the most recent 12 months and stuff. Could you just talk more about that? Because it does strike me like we've pitched this, hey, they're taking share, they all these competitive, but you have one customer who decides at the time, it sounds like they were 20% of the business. And I do remember you mentioning this in the video you did now that I kind of think back on it, but can you just mention why that customer made the decision and why this isn't as big a risk as people might see? Because I do think anybody who's listened to it probably heard that and said, oh, somebody took 20% of the business way in-house in 2018. Like there's a risk we haven't thought about so far.
Yes, right. So I can't tell you exactly what was going through SK Hynix's minds. They decided to take the business for themselves. They thought they'd do well with it. Honestly, I think it ended up doing poorly for them. SK Hynix is not so large in the UFS business, and a major part of that is because Micron, with Silicon Motion's controller, took more of the business of the UFS business market away from SK Hynix. SK Hynix had not a lot, but had a very large position in the eMMC market. And when they transitioned to UFS and used their own controller, they lost a large part of their position in the market to competitors who were using Silicon Motion controllers. I don't think that actually worked out well for them. They replaced their UFS, their non-existent UFS sales to SK Hynix. They replaced it with Micron, with other customers, Intel, other customers that are using their UFS. And they basically replaced all that. Usually you find a company that lose 20% of the revenue. That's not something that you easy to recover from. But if you look at their revenue over the years, it's not so easy to pick out where that 20% loss is, because other parts of the business were growing in such a way to cover that up. They had that and the module maker, the price volatility with module makers and their write-offs. So it was kind of everything going wrong at the same time. And still they were doing quite profitable and not growing, but 2018, 2019, 2020, they were basically treading water as they turned over the SK Hynix business to their other customers. But UFS has been growing for them close to 30% year over year nowadays. So that's continuing to grow, and basically all parts of their business right now are on growth mode.
That's perfect. I just want to come back. We're running pretty long. I just want to come back to a few things. We mentioned why is MXL doing it. I do just want to. They say 100 million in synergies. The two combined companies would have like 570 million in pre-synergies operating income. I'm with you. I think that's a really high synergy number. These two businesses don't exactly fit hand in glove, but at the same time, if you go through the filings, Max Linear does kind of have a history, or at least they say they've got a history of way exceeding synergy targets and mergers. So, I mean, 100 million on, again, 570 million in pre-synergies EBIT. That's a big number, and maybe you think they can exceed it. So maybe you give them some credit there. I want to just quickly look, the merger arb. It sounds to me, and I think you would agree, you're playing this for the fundamental value. If the ARB happens, I mean, you obviously think this is worth more long term, but if the ARB happens, great. You'll take the 60% pop in a day, I guess. I personally think, and you can tell me if you feel differently, I think it's a very, not zero, but I think it's a very unlikely chance. Just China has not approved semi M&A in a long time. And after what the Biden administration did to China's semi industry a couple months ago, I don't think they're improving anymore going forward. I do worry about, for people who listen, Rogers, and it was either Dow or DuPont. I can never remember the two. They had a merger. It was trading very tight. Samir kind of walked it out. And then in early November, Dow looked at Rogers and said, oh, this stock would have been worth 60% less than what we're paying for it. We're just going to walk, because Samir didn't approve. And Rogers stock went from like 250 to 100 in 3 days. I do somewhat worry about that with SEMO, but the nice thing here is everybody knows that China's going to block it, so it's not unexpected.
If the PE drops from 11.5 to 3, then I'm going to start my leverage buyout to take over the company.
Well, I do just want to ask you then. So let's say this most likely, I say most likely, not a guarantee, but most likely the scenario, Samir blocks this in August or so, or they just don't approve it, and MaxLinear walks. So SIMO at that point is going to be a standalone company. They're going to get $160 million in break fee from MaxLinear. That's about $120 tax adjusted. That's about $4 per share. They've got $250 million in cash on their balance sheet. You have to think they'll probably generate a little bit more, even if sales turn down in the near term. They'll generate more cash in the near term.
Cash over the year.
Yep. So I just want to end capital allocation. I know what they've done historically. You know what they've done historically, but what do you think they do? They emerge, the thing breaks. What do you think they're looking at capital allocation going forward, kind of in 2030?
They reinstate their dividend. That's pause for the merger. The dividend $1.40 a share is definitely come back. Maybe have a large amount. They've been pretty good at increasing dividends over time. They've generally been conservative in terms of holding a decent amount of cash. At a certain point, even they felt it was ridiculous. And unlike most companies who buy back shares only when they're expensive, and then when the markets crash and things get a little nervous, they pull back on buyback. Surprisingly, they've actually been above average in capital allocation, and they have been buying back shares at lows, at large buybacks that they've done opportunistically in 2019 and earlier this year, before the merger was announced, opportunistically at low amounts. And if the deal broke and the stock was still holding at 60, 65, I would expect them to do a large share buyback, simply because it would be a lot of cash. It would be close to 450, 500, 600 million of cash on the balance sheet. I would expect them to announce a buyback immediately, and either do it or not, depending on what stock. Because they seem to be pretty good at buying back stock if the stock is low, and buying back less stock when the stock goes up. So that's good.
So just a couple points on that. So dividend, they used to pay, I think it was 50 cents per share per quarter. Is that right? About $2 per year. So you think that's coming back if the deal breaks?
Yeah, for sure. No reason that it might come back at a higher amount.
And that's about 50 million in cash per year. And then, as you said, they've historically been pretty good about buying back shares. Like, look, I don't know many semiconductor companies. It's not like they went whole hog on it, but they bought back shares in 2020. They bought back shares when they were having the customer issues we talked about earlier in 2019 and 2018. Like, these guys do return cash to shareholders. So I would not be surprised if the deal breaks. They get tax adjusted 120, 130 million coming in. They've already got the cash on that. I wouldn't be surprised if they did a tender for 10% of the shares. I wouldn't be surprised if they got pretty aggressive at taking shares out. And obviously that speaks to a management team that sees value in their shares, rewards shareholders, both that and the dividend, all that sort of stuff. Anything else on the capital allocation we should be talking about?
Nothing comes to mind straight now. That kind of sums it up.
Perfect. Hey, Mordecai, last question I always ask. We covered a lot here. I do think we glossed over the M&A angle, both for time reasons and because I think both of us think unlikely it would be a bull case. But anything you think we kind of glossed over, or you wish we had hit harder, or anything we didn't even touch on that you think people should be thinking about here?
Let me give a minute to think about it. No, I think we covered all the bases.
Cool.
High growth, profitable, lower risk, reduced competition, and cheap valuation. That's what I have. If I had 5 companies like this, I'd be set. I'd be able to take vacation.
Well, hey, Mordecai, I really appreciate you coming on. For people, I'm going to include a link to Mordecai's deck on CMO in the show notes. So go check that out. It's a 15-page deck that nicely goes through everything we just spent an hour talking about. And here's the thing. You run 5 stocks. You and I had Twitter in common earlier this year, and I won't disclose them, but I know you and I have 2 other stocks in common right now. So we might have to have you back on the podcast. One of them would be very spicy in terms of the online Twitter outrage. If we did it, we won't mention it here. But Mordecai, I really appreciate you coming on. I think this is great, and we'll have to do it again in the near future.
Yeah, thank you for having me. Good speaking to you.
Thanks to you, man.
A quick disclaimer, nothing on this podcast should be considered investment advice. Guests or the hosts may have positions in any of the stocks mentioned during this podcast. Please do your own work and consult a financial advisor. Thanks.